Welcome back to CAIIB Guru, your trusted companion for cracking CAIIB with clarity and confidence. In today's session, we're going to cover a fundamental concept under the risk management module, risk identification. This topic is not just theory. It forms the backbone of how banks manage credit exposures. So, let's understand it the way a banker should. So, what exactly is credit risk? Credit risk refers to the possibility of a borrower experiencing a change in credit quality either by defaulting on their obligations or simply becoming riskier to lend to. In simple words, it's the risk that a borrower may not repay as promised. Now, this risk has two key components: default risk and credit spread risk, also known as downgrade risk. What is default risk? Default risk is the most direct and straightforward form of credit risk. It refers to the possibility that a borrower fails to make scheduled payments, whether interest or principal, either partially or completely. When a default occurs, the lender typically does not lose the entire amount. They recover a portion of it. This recovered portion is called the recovery rate. Let's take a simple example. Suppose a company borrows 100 Indian rupees lakhs and ends up defaulting. If the bank is able to recover 40 Indian rupees lakhs from the liquidation of the borrower's assets, then the recovery rate is 40%. The remaining 60% becomes a loss. Now, what if the borrower doesn't default but still becomes riskier? This brings us to the second component, credit spread risk. Here, even if the borrower continues to pay, their credit quality may deteriorate. As a result, the credit spread, which is the difference between the yield on a corporate bond and a risk-free bond, widens. In simple terms, investors will now demand higher returns to compensate for the higher perceived risk. This is often reflected by a credit rating downgrade. For instance, if a bond is downgraded from AA to BBB, it signals a higher risk, and its market value may fall, leading to potential losses for the investor. This risk is more relevant to market-linked exposures, such as bonds or securities. Bank loans, especially those in the banking book, are not affected in the same way. This brings us to a very important concept, mark-to-market, or MTM. Bank loans that sit in the banking book are not mark-to-market. That means their value is not updated daily based on market conditions. For such loans, the only event that leads to a direct loss is default. But when it comes to capital market instruments like bonds or derivatives, these are marked to market regularly. Their value changes based on market perception, interest rates, and very importantly, credit spread volatility. That means even if there is no default, the price of a bond can go down simply because the market feels the borrower is now riskier. Another key distinction we need to understand is between transaction-level risks and portfolio-level risks. Default risk and credit spread risk, these apply to individual exposures. That's why we call them transaction-level risks. But when we look at the credit portfolio as a whole, say, all the loans and exposures held by a bank, we consider portfolio-level risks. Portfolio risks can be broken into two types: systematic risk and concentration risk. We'll explore those in more detail in the next session. But just to give you a preview, systematic risk refers to risks that affect the entire economy, like a recession or inflation. Concentration risk, on the other hand, arises when too many exposures are in one sector, geography, or borrower. In the previous part of this session, we discussed what credit risk is, the two major components, default risk and credit spread risk, and how these operate at a transaction level. Now, let's move on to understanding portfolio-level risks, and the first question we need to ask is: systematic risk is the kind of risk that cannot be eliminated, no matter how well diversified your portfolio is. It refers to risks that impact the entire economy or financial system. Think of things like a global recession, geopolitical tensions, high inflation, wars, or even a pandemic like COVID-19. These events don't just affect one borrower or one sector, they impact everyone. Even when a credit portfolio is well diversified across sectors, geographies, and borrowers, systematic risk still remains. It's unpredictable and hard to control. What financial institutions can do, however, is minimize its impact by smart diversification strategies. Now, what if a portfolio is not well diversified? That brings us to concentration risk. This type of risk arises when a bank or financial institution holds too much exposure to a single borrower, or a specific region, industry, or product. In such cases, if that particular segment underperforms, the entire portfolio performance suffers. Let's take a real-world example. During the COVID-19 pandemic in 2020, sectors like aviation, hospitality, and retail were hit hard. Any credit portfolio that had a large concentration in these sectors would have taken a heavy blow. That's why diversification is not just a good to have, it's essential. Overexposure to one segment magnifies your risk. If that segment falls, your entire portfolio feels the pain. So, how do banks actually manage all these different kinds of risk? There are two primary approaches. 1. Standalone analysis. This is usually used for corporate exposures. Here, banks assess the creditworthiness of each borrower individually. They look at balance sheets, income statements, financial ratios. It's a detailed borrower-level analysis. 2. Portfolio analysis. This approach is used more commonly for retail lending portfolios, where the number of borrowers is large. Instead of focusing on each borrower, banks look at the overall risk profile and how well diversified the portfolio is. This is where the benefits of diversification come in. If different borrowers are unlikely to default at the same time, your overall risk is reduced. That means the capital requirement for a well-diversified portfolio is lower, because the probability of simultaneous defaults is minimal. Ignoring this can lead to bad decisions, like allocating more capital than necessary or underestimating risk in concentrated segments. Let's now talk about a related but distinct risk: counterparty risk. Counterparty risk arises not from traditional loans, but from trading activities. It's the risk that your trading partner fails to fulfill their contractual obligation. This failure could be due to refusal or simply inability to perform. Unlike default risk, which plays out over longer time horizons, counterparty risk is typically short-term and more transient. You'll mostly encounter it in activities like derivative contracts, securities lending, repo transactions. Because it's linked to the market, counterparty risk is more volatile and unpredictable, and managing it requires real-time monitoring of exposures and counterparty behavior. Understanding these different risk types and how they interact is critical for any banker or financial analyst. These aren't just exam concepts. They are real-world tools to safeguard the financial system. Before we wrap up, let's quickly tie everything together with one example that shows how all the credit-related risks can play out in a single scenario. A bank has given a large loan to an airline company operating mainly in Southeast Asia. Here's how the different risks come into play. Default risk: if the airline fails to repay the loan, say due to operational losses, the bank may lose money. If it recovers only 30% of the loan, that's the recovery rate in action. Credit spread risk: suppose the airline's credit rating is downgraded from A to BBB. Even if it hasn't defaulted, the market now sees it as riskier, so its credit spreads widen. If the bank holds bonds of this airline, their value will drop due to this perceived increase in risk. Systematic risk: now, let's say there's a global fuel price surge or a recession hits due to geopolitical tensions. This affects the entire aviation industry, not just one airline. Even if the bank diversified its loans across many airlines, this kind of risk hits all of them. That's systematic risk. Concentration risk: if the bank had most of its aviation exposure in just this one airline, or worse, only in the Southeast Asian aviation sector, it faces a higher risk. If that segment collapses, it doesn't have other industries or geographies to balance the losses. That's concentration risk. Counterparty risk: finally, imagine the airline entered into a fuel hedging derivative contract with an oil trading firm. If that counterparty fails to honor the contract due to its own financial trouble, the airline's costs shoot up, affecting its ability to repay the loan. That's counterparty risk, short-term, but impactful. Thanks for sticking through till the end. If this recap helped you connect the dots, don't forget to like, share, and subscribe to CAIIB Guru.